about that. Chapter 11 is on current liabilities and payroll. And actually quite a bit of the chapter will deal with the subject of payroll. You already know from earlier in the course what we mean by liabilities. So liabilities are debts that are owed to creditors. And we can break those down into current liabilities and long-term liabilities. This chapter deals with current liabilities. Then the next chapter that we'll cover next week, chapter 11, will deal with the long-term liabilities. So examples of current liabilities would be accounts payable, sales tax payable, which we haven't talked about before, but we're going to be covering in this chapter, and unearned revenue that we talked about quite a bit back in chapter 3. Okay, sales tax payable. When a company collects sales tax on its sales, that money does not belong to the company. They're just acting as an agent for the state government and collecting the money as an agent for the state government and holding the money in trust until they remit it to the state government with a sales tax return. Therefore, the sales tax money never goes on the income statement as revenue. It goes on the balance sheet as a liability, but not on the income statement. So here's an example that says December sales tax, or taxable sales, for Smart Touch Learning total $10,000. The company collects an additional 6% sales tax, which equals $600. So here's what the journal entry would look like to recognize the sales revenue and the tax. We would debit cash, $10,600. We would credit sales revenue, $10,000. And we would credit sales tax payable, $600. Then on the 20th of the following month, the sales tax return and the check for the sales tax money will be sent into the state. So on that date, we will reverse the payable amount. So we will debit sales tax payable, $600. We will credit cash, $600. Now, there's a reason why this says January 20th, which is that in most states, including Florida, the sales tax money is due on the 20th day of the following month. So that's when the sales tax return would be sent in. Okay, next short-term notes payable. It says on November 1st, 2018, Smart Touch Learning borrows $10,000 from First Street Bank at 6% for 5 months. On November 1st, the accounting clerk records the following entry. Cash is debited, $10,000. Notes payable is credited, $10,000. So we're putting notes payable on our balance sheet as a liability. Remember back in chapter 8, we dealt with notes payable, but there we were the party that was lending the money. Therefore, it was an asset called notes receivable. Here we're the party that is borrowing the money. Therefore, it goes on our balance sheet as a liability, and we call it notes payable. Then on December 31st, at the end of the year, we have to accrue for interest expense. And so at this point in time, 2 months have gone by. So the way we would calculate the amount of interest is that it's the $10,000 of principal times the 6% interest rate times 2/12 for the 2 months that have gone by. So that's a total of $100 of interest so far. So for the accrual, we would debit interest expense, $100. We would credit interest payable, $100. Then the note will be due on April 1st. So in this case, there are going to be 3 separate accounts that we need to debit. Remember back in chapter 8 when a note became due and it was notes receivable, in that case there were 3 separate accounts that we had to credit when the note became due. So in this case where it's notes payable, there are going to be 3 separate accounts that we have to debit. So first of all, we debit notes payable for the principal amount of the note, $10,000. Next, we debit interest expense for the 3 months of interest that have been owed since the first of the year, since we last accrued for interest expense. And then we next would debit interest payable to reverse the accrual that we made for interest back on December 31st in our previous journal entry. And then we would credit cash for the combined amount of those 3 debits, the amount of cash that we will be paying to the bank for the principal and interest amount of the note combined. Now, with some notes payable, some of the principal payments are made within the first 12 months, and some of the principal payments are made at later dates. In that case, the note is split into 2 parts, and the payments that are due within 12 months are recorded as current liabilities on the balance sheet. And on the balance sheet, it will be called current portion of notes payable. Then the rest of the principal amount of the note will be under long-term liabilities, and that will just be called notes payable, or it might be called long-term notes payable, but often it's just called notes payable. We sometimes refer to that process of putting part of it under current liabilities as reclassifying part of the note as a current liability to show that some of the payments on it are in fact due within the next 12 months. Okay, now we get to the material on payroll. And there are a number of terms that are covered in the book dealing with payroll, and I'm not going to really spend time on these because I think you already are familiar with a lot of this terminology, but some of the terms that they give you are salary, compensation, commission, bonus, benefits. One type of problem that you are likely to run into in my lab is where an employee works more than 40 hours a week, and therefore, unless the employee is in management under state and federal law, the employer is required to pay overtime to the employee. And overtime must be paid generally at a rate that's 1.5 times the regular wage rate for that employee. So we have a problem here where it says that Ryan has a regular wage rate of $15 per hour that applies to his first 40 hours per week. And he works 42 hours during this particular week. So we're asked to calculate what his total gross pay is for the week. So 40 hours times $15 would be $600 for his straight time pay. And then for overtime, it would be 2 hours at a rate of $22.50, 150% of his regular pay rate. And so that's $45. So adding those 2 figures together, his total gross pay for that particular rate or particular week would be $645. Gross pay is the stated amount of salary or wages and commission and bonuses that employees earn during a particular pay period. Net pay is the amount that employees actually get in their paychecks after deductions are taken out. And another term that is used for net pay is take-home pay. Now, the deductions that are taken out of paychecks fall into two categories. There are required deductions and optional deductions. So required deductions would typically include federal and state income tax. In Florida, we don't have a state personal income tax. However, 41 states do have a state income tax, and some cities also have income taxes. So if you lived in or worked in New York City or Philadelphia, for instance, there would be a city income tax. If you worked in Ohio, the counties there have school district income taxes that you have to pay. So in many places, there are really three separate income taxes that would be deducted from your pay. Then there's also the Social Security tax, and there could be other required deductions as well. Then the optional deductions would be for things like insurance premiums that maybe the employer and the employee each pay part of, retirement plan contributions like a 401k plan, and charitable contributions like United Way. Now, for income tax withholding from the employee's paycheck, as you probably know, the employee, when they start a new job, has to fill out what's called a Form W-4. That's an IRS form where you indicate how many withholding allowances you are claiming, and you also indicate whether you are married or you're single and you want to have your taxes withheld at the higher married rate. And then the employer keeps that W-4 form on file. They don't actually send it in to the IRS, but they have to have it on file in case they ever get audited by the IRS. And then they use something called IRS Circular E to figure out, based on your withholding allowances, how much they're supposed to withhold from each one of your paychecks in the form of income taxes. Now, the Social Security tax that is withheld from your paycheck, the formal name for that is Federal Insurance Contributions Act. So sometimes we use the term FICA for that. And then there are two parts of FICA. One part is OASDI, which stands for Old Age Survivors and Disability Insurance. I tend to refer to that as the Social Security part, but the authors use the term Social Security to refer to the entire FICA, including both parts of it. So it can be confusing what exactly people are referring to by Social Security. And then the other part of it is Medicare, to pay for Medicare benefits. Now, the Social Security tax only applies up to a certain amount per year, which is called the Social Security wage base. So in this particular example, at the time that the textbook was written, the maximum amount per year per employee that Social Security applied to was $128,600 of earnings. And so you may have a problem like this where, no, it's not, I'm sorry, I'm looking at what his pay was. At the time the textbook was written, the maximum per year that Social Security applied to was $132,900. That's called the Social Security wage base. So in this particular problem, the employee up through the month of November had earned $128,600. In the month of December, he earned an additional $10,000. So we have to figure out what part of that $10,000 is going to be subject to the Social Security tax. Because part of it will be, but not all of it will be, because part of it goes above the Social Security wage base of $132,900. So you can see from the math here, they figured out that the part of it that is still going to be subject to Social Security in December is going to be $4,300. They take that times the Social Security tax rate, which is 6.2%, and that gives you a Social Security tax for the month of $267. Then to figure out the Medicare tax, there's no maximum that applies to. All wages are subject to the Medicare tax. So his December wages are $10,000. This Medicare tax is generally 1.45%. So his Medicare tax for the month is $145. So then adding together his Social Security tax and his Medicare tax, his total FICA tax withheld for the month of December is $412. If you were to look at what the Social Security wage base is this year, 2023, it's quite a bit higher now. It's $160,200. It keeps going up every year because in order to keep the Social Security Trust Fund solvent, they have to keep raising the amount of wages that it applies to. But for every problem that you need to do in MyLab, they will tell you what figure to use as the Social Security wage base. And although it's not too hard to remember, I believe they will also always tell you that the Social Security tax rate is 6.2%, and they'll tell you that the Medicare tax rate is 1.45%. Okay, then this particular employee also has some optional withholding deductions. So those are for health insurance and for United Way. So if we were to look at all of his withholding deductions, they're shown here on this slide. So his gross pay is $10,000. Then we list all of his withholding deductions, both the mandatory ones and the optional ones. So his total withholdings are $2,612. So that leaves him with net pay of $7,388. Now, this is a different example. It's not James Colon, but it's probably for all of the company's employees combined. Here's the way that we would do the journal entry to record the company's payroll. There would only be one debit entry here, which is for the gross amount of the payroll, the gross salaries and wages. And the account that we would usually use for that would be called salaries and wages expense. So in this particular example, it's $28,580. Then the credits would be for all of the withholdings, both the mandatory ones and the optional ones. So you see here, the credits include both parts of FICA and the income taxes and the employee health insurance and the United Way. And then finally, we also have a credit entry for the take-home pay. And what we call the account that we credit for that is salaries and wages payable. Okay, then the payroll is actually going to be paid out in this case on January 5th. So on the date that we cut the payroll checks, then we can reverse that entry that we made on December 31st to salaries and wages payable. So here we debit salaries and wages payable for the take-home pay of $19,727, and we credit cash for that amount, for the checks that we're actually writing out. Okay, then we also have employer payroll taxes. Now, the taxes that we were talking about up to this point in time that are withheld from employees' paychecks, those are not expenses to the employer. Therefore, they would never show up on the employer's income statement. They're simply withheld from the employee's paychecks. But the employer payroll taxes are actually employer expenses, and they would go on the income statement as expenses. And here are the ones that you usually run into. First of all, the employer pays a matching share of the FICA tax for both Social Security and Medicare. And the employer also pays unemployment compensation taxes. The employee does not have anything withheld from their wages for unemployment comp taxes. That's only the employer who pays for that. And the employer pays both a state unemployment tax and a federal unemployment tax. The state tax is usually called SUTA for short, and the federal tax is called FUTA for short. So here's a good diagram that shows what the employee's taxes are and what the employer's taxes are. So for the employee, there's Social Security of 6.2%, there's Medicare of 1.45%, and then there's income tax withholding, which in this particular example we're assuming is 20%. Then for the employer's taxes, because they have to pay a matching share of FICA, the employer also pays 6.2% Social Security. The employer also pays 1.45% for Medicare. Then in this example, we're assuming that the employer pays 0.6% of the first $7,000 of each employee's wages for FUTA. And that, by the way, is an accurate figure for what the FUTA tax is right now. And then for SUTA, they give an example here, but that's actually different in every state. So that's kind of an oversimplification. But in this case, they say that SUTA is 5.4% on the first $7,000 of each employee's wages. Now, the way it works in Florida is that if you're a new employer, the SUTA tax starts out at 2.7% of the first $7,000 of each employee's wages. And then after you've been in business for 3 years, you become experience rated. So during the first 3 years, if you've never laid off any employees, your tax rate goes down to 0.1%. If you've laid off lots of employees, then your tax rate goes up to the maximum of 5.4%. But other states work a lot differently. So if you were in Massachusetts, the wage base, instead of being $7,000 per employee, it's $40-something thousand per employee. The reason for that basically is that in Massachusetts, the unemployment benefits are much higher, so they have to collect a lot more money in tax revenue to pay for the unemployment benefits there. So every state's going to be different as far as what the SUTA tax actually is. And again, if you're doing problems like this in my lab, they will always tell you what figures to use to compute the FUTA and SUTA taxes. Okay, here's how we would do the journal entry for the employer's taxes. So as I mentioned, in this case, it is actually a tax expense to the employer. So the account that we would debit would be payroll tax expense. And then here there would be 4 different accounts generally that we would credit. The first one would be for the employer's share of Social Security. The second one would be the employer's share of Medicare. The third one would be for FUTA, and the fourth one would be for SUTA. Now, on January 15th in this example, the employer is going to send all of the money in to the IRS and the State Department of Revenue and to United Way and Blue Cross and whoever else money is being sent into. So here's what the journal entry is going to look like for that. First of all, we're sending in the money to the IRS for the Social Security tax. That's where it says FICA, OA, SDI. Now notice that we're sending in the money for both the employee's share and the employer's share. That's why it's double the $1,419 amount, because we have to send in both the employees and the employer's share. And then likewise, when we send in the money for FICA Medicare, it's double because we have to send in the employee's share and the employer's share. Then when we send the IRS the money for the employee income taxes payable, that came just from the employee withholding. The employee health insurance payable, in this example, I think came only from the employee. And United Way payable came only from the employee. And then the FUTA tax and the SUTA tax, those came only from the employer. And then we only have one credit here, which is the cash. So we added up the total amount of all of our debits, and whatever came to, that's the amount that we would credit the cash here for the total amounts of the payments that are being sent into the different authorities that the money would be going to. Okay, next subject is liabilities that must be estimated. So these are things where we don't know for sure the dollar amount of them, but under GAAP accounting rules, we still have to put a liability on our balance sheet. So some examples of these liabilities would be bonus plans, vacation pay, health and pension expense benefits, and warranties. If your company offers paid vacation pay to employees, as an example, and there's vacation pay that the employees have earned and they haven't taken the vacation pay yet, you do have to put a liability on your balance sheet for the amount of vacation pay that is still owed to your employees. That's just part of the GAAP rules. A lot of small businesses don't do that if they're not required to follow GAAP, but if you do follow GAAP, you would be required to do that. So the example that we're going to look at here of how we handle estimated liabilities would be warranties. And you're probably already familiar with what we mean by a warranty. So if a company guarantees their products against defects for a certain period of time, that would be a warranty agreement. And because of the matching principle that we've talked about before, under GAAP accounting, we're supposed to record the warranty expense in the same period as we record the sales revenue, because at the time we make sales, we know based on our past experience that we're going to have warranty claims on a certain percentage of the products that we sell. So we should immediately record expense for the warranties based on what our past experience is with receiving warranty claims on our products. So here, with this example, it says the company made sales on account of $50,000 with the cost of the inventory being $35,000, subject to product warranties. This was on June 10th, and they estimate that warranty costs will be 3% of sales. So the first two journal entries here are just review from things we've done before. So the first journal entry is recording the sales revenue. The second journal entry is recording the cost of the sales. And then third journal entry is where we recognize the warranty expense. So 3% of the $50,000 of sales would be $1,500. So the account that we are going to debit will be warranty expense, and then the account that we credit will be a liability account that we're going to call estimated warranty payable. That will go on our balance sheet. Now, on June 27th, we experienced actual warranty costs of $800 from replacing defective goods resulting from warranty claims that our customers make. And so on that date, we don't have to recognize any warranty expense because we already did that back on the earlier date, June 10th, when we set up that allowance for warranties. So now we debit estimated warranty payable to take it out of that liability account that we set up earlier. And in this case, because we're replacing the defective goods with new goods taken out of our inventory, the account that we credit is merchandise inventory. Now, there may be other examples where the way that you satisfy a warranty claim is that you repair the customer's product instead of replacing it. And so if you repaired it, then the account that you credit, instead of being merchandise inventory, could be cash, it could be accounts payable, it could be wages payable, it could be a number of different things. But whatever the cost was to repair their product, you would be crediting the appropriate account for that instead of crediting merchandise inventory. So you just have to read what the problem says. Did they replace the product, or did they do something else to repair the product for the customer? Okay, then next subject is what we call contingent liabilities. A contingent liability is a potential liability that may or may not become an actual liability depending on some future event. And the way that you handle the accounting for this depends on the likelihood of that future event occurring. And so for GAAP accounting purposes, there's a table that tells us how we should account for these events. If the likelihood of the future event occurring is remote, then the appropriate accounting for this is that we don't have to disclose the situation at all. So a typical example of this is that, and these contingent liabilities, by the way, very often they will involve lawsuits or some type of litigation. So if somebody files a frivolous lawsuit against our company and our attorneys tell us that it's a frivolous lawsuit and it's very unlikely that we'll have any actual damages that result from that, then that means that it's remote that we'll have damages, Therefore, we don't have to do anything to disclose that in our financial statements. Now, if it's reasonably possible that we'll have an actual loss from this future event, whatever it is, then what we need to do is describe the situation in a note to the financial statements. If it's probable that we'll have an actual loss and the amount of the expense cannot be estimated, then the accounting treatment is exactly the same as it would be if it's reasonably possible. So we would describe the situation in a note to the financial statements. If it's probable that there'd be an actual loss and the amount of the expense can be estimated, then we're supposed to record an expense and a liability based on the estimated amounts. So here's what the journal entry would look like in that case. Let's say we failed to pay our workers overtime, and our law firm tells us it's very likely that if this goes to trial, we're going to lose the lawsuit, and so we might as well settle with the employees. And if we settle with the employees, we're going to have to probably pay out about $100,000. Well, then what we should do is journalize it something like this. We would debit estimated loss from lawsuit $100,000, so that would go on our income statement as an expense, and we would credit estimated lawsuit payable, and that would go on our balance sheet as a current liability. There's one ratio at the end of this chapter that's called the times interest earned ratio. That's is used quite a bit in business. It's to measure a business's ability to pay their interest expense. Another name for it is the interest coverage ratio. And the formula for it, in the numerator, you take net income plus interest expense, or plus income tax expense, plus interest expense, and then the denominator is just interest expense. And the basic idea here is you're looking at about how many times the cash flow does the company have compared to the actual amount that they would need to have to pay all of their interest expense. So here's some sample data that we have from Kohl's Corporation. And so when they calculated the times interest earned ratio for fiscal 2016, the ratio was 4.23, and for fiscal 2015 it was 4.97. So these are pretty good ratios. So Kohl's had about 4 or 5 times as much available cash flow as what they would actually need to have to be able to pay their interest expense. If you're wondering why income tax expense is part of the numerator of the formula here, it's because interest expense is tax deductible. So from a theoretical perspective, it's more appropriate to look at what cash flow you have available on a pre-tax basis. Okay, then we'll go to some practice problems in my lab. This is a payroll problem. it says Macintosh Company has monthly salaries of $25,000. And so we're supposed to do the journal entry to accrue salaries, expense, and payroll withholdings. So recall that the account we debit is going to be for their gross payroll. And we will generally call that something like salaries expense. So that will be $26,000. Okay, then for our credits, it will include everything that gets withheld. So up at the top of the problem, they say that total income tax withheld is $2,000. So we can say employee income taxes payable, and so that's going to be a credit of $2,000. And then it says the only payroll deductions are payroll taxes. So next one I guess I would list would be FICA, OA, SDI, or what I would normally call Social Security. So I'll split my screen here so we can calculate that. So 26,000 wages times 6.2% be $1,612. And then next we would do FICA Medicare taxes payable. So 26,000 times 1.45%, be $377. And those should be all of the deductions. And so then the other credit would be for the net pay or take-home pay. And the account that we use for that would be salaries payable. And so if we were to subtract these three deductions from the gross wages, we would end up with 22,911. No, 22,011. And at the bottom, we would put to record salaries, expense, and payroll withholding. Okay, next, record the entry to accrue employer payroll taxes. So we know for this, usually the debit will be to payroll tax expense, and then we'll probably have 4 different accounts that we credit. So first one we'll do would be FICA, OA, SDI, payroll taxes payable, and so this is easy to calculate because it'll be the same amount as the employee share. So up under the employee share, it was 1,612. So we can also put 1,612 here for the employer. And then next we'll do Medicare. And for the employee, it was 377. So we'll also put 377 here for the employer. And then next we'll have FUTA, the federal unemployment taxes payable. So I'll split my screen. It says, if we read the problem, no employees have reached the payroll tax limit. So although there's a $7,000 limit per employee, they're saying that none of that comes into play yet. So and what do they tell us about the rates? Oh, we have to open this up. They tell us that FUTA is 0.6%, so 26,000 gross payroll times 0.6% be $156. And then for the state, the SUTA tax, they say 5.4%. So 26,000 times 5.4%. So it'd be $1,404. All that state unemployment taxes payable, 1,404. So then adding together the amounts of these four credits, the total amount that we would use as our debit for payroll tax expense would be $3,549. And at the bottom we put to record employer's payroll tax expense. Okay, now record the payment of employee and employer payroll taxes. So we're sending the money in now. So we'll start with FICA OASDI taxes payable. So here's where we have to add together what we had from the employee's share and the employer share. So 1,612 times 2. So that would be $3,224. And then next we have FICA Medicare. And so $377 times 2, that would be $754. Then next we could put employee income taxes payable. That would come just from the journal entry for the employee. That was $2,000. And next we could put the FUTA, federal unemployment. That comes just from the employer. That was $156. And then we have SUTA, and that comes just from the employer. So that was 1,404. And then the only account that we are going to credit is cash. And so adding up all of our debits, the combined total of that will credit cash would be $7,538. And then at the bottom we'll put payment of payroll taxes. Okay, next one involves contingent liabilities. It says Freeman Motors, a motorcycle manufacturer, had the following contingencies. Determine the appropriate accounting treatment for each of the situations Freeman is facing. Okay, the first one says Freeman estimates that it is reasonably possible, but not likely, that it will lose a current lawsuit. Freeman's attorneys estimate that the potential loss will be $4,500,000. So from this drop-down menu, which one of these accounting treatments would be appropriate for that?
record an expense?
No. It's reasonably possible but not likely. That's when you describe the situation in a note to the financial statements. Okay, then next, Freeman received notice that it was being sued. Freeman considers this lawsuit to be frivolous. The wording for this is really not right, because under GAAP accounting, what you're supposed to do is you're supposed to check with your law firm. You're not supposed to make the decision yourself as management. You have to consult with attorneys. But let's assume that your attorneys told you that the lawsuit is frivolous. So then in that case, what do you do?
Do not disclose.
Right, you don't have to disclose that. Okay, then next, Freeman is currently the defendant in a lawsuit. Again, here you should consult with your law firm. If the law firm believes it is likely that you'll lose the lawsuit and estimates that the damages to be paid will be $75,000, then what do you do? Right, record an expense and a liability based on the estimated amounts. Okay, then next we have a warranty problem. And first of all, we're supposed to journalize the warranty expense. I'll split my screen here. So it says that our sales are $113,000. In the past, warranty expense has been 9% of sales. So we take $113,000 times 9%. And so the account we debit would be warranty expense, and so the dollar amount would be $10,170. And the account that we would credit would be the liability account that we call estimated warranty payable. Okay, then next it says journalize the warranty payments. So up at the top it says they paid $7,000 to satisfy warranty claims. So here, notice with this wording, they're not replacing the product. Makes it sound like they paid out cash to satisfy the warranty claims. So we take this out of the estimated warranty payable that we set up earlier. So before we credited estimated warranty payable, so now we're going to debit estimated warranty payable for $7,000, and then we will credit cash $7,000. Oh, I put it on the wrong line. Okay, then we're supposed to do the T account for estimated warranty payable. So it had a beginning balance credit of $5,000. So in the first journal entry, we did a credit to that account of $10,170. And for that, we would call that the accrual. And then in the second journal entry, we had a debit of $7,000, and we would call that payments. And so then to balance the T account, it would have a credit balance of $8,170, and we would call that the ending balance. Okay, then I have some multiple choice problems here that you can help me with. This one's worded kind of awkwardly. On April 1st, Orbit Services received $5,800 in advance of performing the services for a customer for 3 months of service, April, May, and June. What would be the journal entry to adjust the accounts at the end of May? And this is kind of review for, I think, from chapter 3, but so apparently what they're saying is that they did not adjust the accounts at the end of April. So when they're adjusting the accounts at the end of May, the adjustment needs to cover both April and May. So at this point in time, at the end of May, 2 of the 3 months have gone by that the service contract covers. So the way I would do this is take the $5,800 that the service contract is for times 2/3. Because 2 of the 3 months now have gone by. So that'd be about $3,867. So it's going to be either answer B or answer C. So which one of these do you think would be correct then?
The one that says unearned?
Yes. Thank you. Yeah. So we would debit unearned revenue 3,867, credit service revenue 3,867. Okay, Norwood Inc. signs a $17,500, 10% 6-month note dated November 1st. The interest expenses recorded for this note in 2024 will be, okay, so we've done other interest calculations before. So for this one, take the principal of $17,500 times 10%. And so 2 months have gone by, November and December. So then times 2/12.
292.
Okay, $292.
So it's supposed to round, but yeah, it says round to the nearest dollar.
Okay. And Peter earns $15 an hour straight time. He worked 47 hours. So 47 times, well, no, that's not right. So 40 times 15 plus 7 times 15 times 150%.
That's receipt.
Okay, $757.50. Okay. Okay, Brad's gross pay for the month is $6,400. His deductions for federal income tax is based on a 22% rate. He has no voluntary deductions. His year-to-date pay is under the limit for OASDI. What is his net pay? Okay, so we'll start with his gross pay, $6,400. And then we'll subtract his income tax. So that would be his gross pay times 22%. What I do wrong here? Okay, then his, for his FICA, we can combine the rates for the two types of FICA, so, his $6,400 times 7.65 is the rate for the two parts of FICA combined. And so then, total that,
$5,502.
I got $4,502. That would be his take-home pay. Okay, these two people are employees of Freestar Inc. Which of the following would be included in the entry to record the salaries expense for February? Well, the only debit would be to salaries expense. So neither one of these debits is going to be correct since they're not to salaries expense. And furthermore, you don't credit salaries expense, you debit it, so that one's not right. So the only answer here that could be correct would be to credit FICA OASDI, so we don't even have to figure out the dollar amount. See, the only answer that would make sense
Wow.
would be to credit FICA OASDI. Okay, Jason's gross is 900. His year-to-date pay is under the limit for OASDI. What is the total amount of payroll taxes that his employer must record as payroll tax expense? So for FICA, $900 times 7.65%, so combining Social Security and Medicare, that would cover that. And then for SUTA and FUTA, they're saying 6%, so $900 times 6%, ooh, $900, right?
Mm-hmm.
And then add those two numbers together. So it would be $122.85. Okay, Jack's gross pay for the week is $1,600. His state and federal unemployment taxes are 6%. His year-to-date pay has previously exceeded the $7,000 cap. What is the total amount of payroll taxes his employer must record as payroll tax expense? So the important thing here to note about the wording of this is that he's already passed the $7,000 cap. So that means there is no FUTA or SUTA. So the only thing to figure out would be the FICA tax. So 1,600 times 7.65%. So it would be $122.40. Okay, a contingency was evaluated at year end and considered to have a remote possibility of becoming an actual liability. If this was not reported on the balance sheet or in the notes to the financial statements, what effect would this have on the financial reporting of the company?
Same.
Yes, there would be no effect because you did not have to disclose it. Good. A contingency was evaluated at year end and considered to have a reasonable possibility of becoming an actual liability. If this was not reported in the notes to the financial statements, what is the effect on the financial reporting of the company?
Their information about the transaction will be inadequate.
Right, it would be inadequately disclosed because you were supposed to disclose it in the notes to the financial statements. Good, thank you. Which of the following is an example of an estimable probable contingency?
B.
Yes, warranty payable is the example that we were looking at, yes.
Perfection.
Okay, that's it. Did, any